Last week was fairly strong for the S&P 500 overall. However, there were some notable stocks that were down, like Alphabet more than 4%, one that we did in fact cover last week. But today we want to focus on the other, which is Amazon, down around 3%, and we do believe this is a very good stock to consider for the portfolio, one of the best in the AMZN right now as well. And we also notice something that Wall Street agree on with their strong buy. Seeking Alpha also give this a buy, and although we see Quant giving this a hold, 3.49 is not far off the 3.5 to flip this to a buy. So we're going to understand how this company has performed, why we like it, and how much undervalued it is, and our buy price. First thing to note, how did they perform in their more recent earnings from just a few weeks ago? And as we can see, the headline reads, they popped on the earnings beat as well as some notable cloud growth. No surprises then, they reported better than expected both on the EPS as well as the revenue, and when we get down to the numbers, they are looking very, very impressive. EPS 143, that is a massive beat from the 114 that the market was expecting, and the revenue, as we can see, more than 1 billion higher, 158.9 above the 157.2 the market were anticipating. And with this company, Wall Street also go into a bit more detail into a few different metrics. The first one is their AWS, which as we can see did come in marginally under 27.4, lower than the 27.5, and we can see the advertising coming pretty much straight in line, 14.3. Again, analysts were expecting the same. Now, in comparison to the previous quarter, well, their top line was up 19%. We also noticed in comparison to the same quarter last year, another double-digit increase at 12%. But one thing that we need to understand with Amazon, they are investing heavily. A lot of capex is being spent to invest, as we can see here, data centers as well as equipments like NVIDIA GPUs, something that we have heard a lot, not just from Amazon, but Meta platforms as well as others. Capital expenditure is really ramping up. In fact, when we look at the actual number, it is up 81% on a year-on-year basis, from 12.48 billion to right now they're spending 22.62 billion. We also heard from the CEO Andy Jassy as well, saying that the company plans to spend around 75 billion on capex in 2024, and he doesn't go on to stop there. He said that he believes the company will continue to spend a lot more into 2025, and all of this is being driven by generative AI. They believe this is the future, and ultimately they don't want to be left behind. Now, in his own words, he says that it is a really unusually large, maybe once in a lifetime type of opportunity, and he also said shareholders will feel good about this long term and that they are aggressively pursuing it. So don't believe this capex to stop anytime soon. And on the side note, you could argue this is also very, very bullish for NVIDIA as well. Companies, AMZN as well as others, are really ramping up their capex spending. Now, we also note for the current quarter, they are anticipating around 181.5 to 188.5 billion, and that would represent 7 to 11% on a year-on-year basis. However, one thing that we do note, in comparison to what the market are anticipating, it is lower. They were looking for around 186.2. We also notice operating income, something that maybe isn't talked about a lot, is up around 56% on a year-on-year basis. So we do believe there are a lot of strong points about this company that we do anticipate will help when considering whether or not this is one you should consider for the portfolio. And we can see maybe one thing that isn't discussed as much, but a lot of cost cutting is being performed by the CEO. It says more than 27,000 jobs since the beginning of 2022 have been effectively cut, and the restructuring is still going on. This isn't something we have heard the last of. Now let's go back to this company. Over the last year, up more than 34%. Over the last 10 years, no surprises, you would have massively outperformed the S&P, up more than 1,070%. Now we do notice it is towards the upper end of the 52-week range, but has a pullback from the all-time highs we saw of $216, a near enough 10% pullback. And as we said, buy ratings pretty much across the board. In terms of forward PE, 38.6. We'll touch upon that shortly as well. And it is looking good in terms of their metrics. Now, we also want to show you a few graphical bases of how they performed in that latest quarter, just so you can understand not the size of this company, but also the growth for in fact the large size. In terms of their net sales on a trailing 12-month basis, it continues to go up. Already mentioned 12% on a year-on-year. This is something that we do want to see, but maybe something we also take for granted. With a lot of growth being seen right across the board, this is something that we believe won't stop, but we do need to have considerations for both bearish and bullish indicators. In terms of operating income, we already spoke about the large growth it's seen, around 56% from the previous quarter. We've already spoken about the large growth from the earnings report, but on a year-on-year comparison, up triple digits, up 130%. Remember, yes, this company does trade at a very high valuation, but you need to question whether or not you believe it has the supporting metrics to uphold that price. In terms of the bottom line as well, we do notice that is also up triple digits, 148% on a year-on-year perspective. And one thing we always like to focus on is the free cash flow. It does ultimately make up some of the valuation when we come to our own intrinsic value as well as our margin of safety. That is also a little bit inconsistent, but nonetheless up triple digits, 123% on a year-on-year basis. Now, in terms of growth, moving forwards, Amazon also anticipate double-digit increases every quarter to the earnings per share, and we also notice they have massively outperformed when we look back from the last 4 quarters. That is a 100% track record. Now, if they do hit their December 2025 next full year accounts EPS estimate of 6.15, the forward P will come down to around 32.04. Now, we also want to highlight some of their metrics that we find very important, not just to pinpoint for Amazon, but also for the majority of companies we discuss on the channel. First one, free cash flow per share, where we do see companies that increase their free cash flow over a longer period in a consistent basis. Now, we don't note that in 21-22, but before that and after that, we do get the consistent increase. In fact, do notice that over the next 12 months, free cash flow of Amazon is anticipated to rise sharply, nearly double to $5.99 per share. Then we move on to the sales growth, where 9 of the last 10 years have seen double-digit increases, and we notice in 2023, 12% looking very good, as well as on a trailing 12-month. So you may consider growth is starting to slow down, but they are still able, with the very large numbers they turn over year on year, 12% double-digit is still very, very impressive. When you do zoom out though, no surprises. Given the share price increase, their top line revenue has also reflected that massive growth right across the board. One thing though we do have to point out, shares outstanding, meaning that they have been issuing equity over the last 10, diluting your position as a shareholder, but ultimately you wouldn't really care about this given how fast that share price has increased, as we saw around 1,000% over the last 10. ROIC, one thing we do want to consider, one of our favorite metrics in fact, 10% or more, give us faith management are able to effectively allocate their capital. Now it does straddle around that if you take the average, but we want to see a bit more consistency. Nice to note, 15% on a trailing 12 month, they are moving ultimately in the right direction. Then we get to operating margin. Typically for this metric, 2 things we want to see, minimum 12%, but also operating efficiency with margins increasing. Now, you could look at it and say, look, it was 0% in 2014, 10% on a trailing 12 month. It is moving in the right direction. We just don't get that minimum 12% that we do like. Again, something we can factor in to our margin of safety later on. And free cash flow margin, at least 5% year on year. You could say again, on average, it does hit that. 7% on a trailing 12 month does look reasonable as well. We then move on to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. We want below 3. Now, these are the numbers of years it would take Amazon to pay off all of their debt net of cash on hand. Now, reason why we focus on this, it does correlate to balance sheet strength, and it's actually very good. 0.48 on a trailing 12 month, 0.41 over the next 12 months, indicating to us they do have a very strong balance sheet, something we will come to highlight as well when we take a look at both income statement and the balance sheet review. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where essentially we flag severely undervalued dividend stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away, and also grab a copy of 40 undervalued dividend stocks for the month of November. Lots of information for each, as well as the upside that Wall Street see over the next year. And you can also grab a recently released spreadsheet that runs through 29 dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 as of today's date. So click below, sign up, and you can start reading straight away. We then move on to insider ownership that's very high, just below 11%, with around 8 billion worth of sales by these insiders over the last 12 months. Quite a significant amount in the more recent quarter of 1.25 billion. And when we look to see who these insiders are, well, we noticed the more recent one just a few days ago. In fact, last week, the director sold more than 1,000 shares. And we can see, in fact, he's sold more in the week priors. And also, we have Bezos, who's been selling a significant amount when the share price does go above $200. So a lot of selling going on, but do remember, it isn't necessarily what we would consider to be a bearish signal. Management sell for many reasons, personal or financial. But again, information is here if you do want to use it as part of your overall investment thesis. Institutional ownership, well, 72%, around 22 billion worth of sales over the last year, and in the same time frame, nearly 4 times as much buying. When we do look at Q3, the more recent data point, in fact, every quarter for quite a large number of periods, we do notice institutions have been buying a lot more shares of Amazon than selling, so they are incredibly bullish. Do remember though, very, very important, never copy insiders or institutions, and always do your own due diligence. Now, we did highlight the top line revenue as we saw some very, very great growth over the period. As we said, double digit nearly every single year. But we didn't flag the bottom line net income, something we want to understand. Is it a lot more typical? Does it follow the top line revenue? And we get to see here a little bit of inconsistency. In fact, since 2021, it has been decreasing into a net loss. And then we see a net profit, but that is under the 2021 position. Now, when we look back in 2014, a net loss of 241 million, 30.4 billion net profit in 2023. But again, inconsistency on a year-on-year basis. Positive to take is on a trailing 12-month at 50 billion. We do anticipate 2024 to be a very strong year for Amazon. Now let's have a quick look at the health of the company, total cash versus total debt. And like their top line revenue, cash has been increasing over the period. In fact, it's gone from 17.4 billion in 2014 to 88.1 in the latest quarter. But don't forget, any one of these numbers in pure isolation isn't going to tell us anything, which is why we compare it to their total debt, both numerically and directionally. Now, similar to the cash, similar to the revenue, debt has also been increasing, around 14 billion in 2014 to 159 in the latest quarter. Now that is significant. It is larger than the total cash amount that we saw, but when we did look at the net debt to EBITDA, it did look to be decent. It was below 3 consistently, so no major worries for the time being based on this information. Now we're going to look at some gradings. First one, valuation, where they get a D. No surprises, as their forward P at around 38.6 does sit much higher than the sector median of 17.6. Right now, if you are buying this company in relation to the overall sector, you are paying a premium of 120%, and that is reinforced no matter what valuation metric you use. Amazon, surprise, surprise, is trading at a premium. Is it worthy of a premium? In our opinion, yes. The question you need to ask though is how much of a premium, and that is what we'll get to. Why do we believe it's worth the premium? Well, look at the growth grade. They get an A-. As we can see, year on year, 12%, sector median 2%, forward looking 11%, sector median 3.09. And when we also look at the earnings per share over the next 3 to 5 years, anticipated 23.2%, significantly better than the sector median at 10.6. Doesn't just stop there. When we take a look at the profitability, an A+, 48.4%, sector median 38. Bottom line net income 8.04 versus sector median of 4.39. And then we get to the cash from operations, 113 billion over the last 12 months, sector median 279 million. Now a quick recap, this part of the analysis: strong buy from Wall Street, a buy from Seeking Alpha, and as we said, quant pretty much on the fence between a buy and a hold. D on valuation, A- on growth, with an A+ on profitability. Now, 2 more things before we do jump into the valuation model, comparing their performance over the last 10 against others in a comparable size and industry. Total return over the last year, Amazon the best performing, up 35%. When we extend this to over the last 5 years, it doesn't become the best performing, but still up a respectable 126%. When we zoom out over the last 10 years, second best, up 1,064. Only second, in fact, to Mercado Libre, up 1,339%. Remember, yes, we believe this is a phenomenal return, and you'd probably bite our hands off if we said your portfolio would get that over the next 10. But remember, past performance is not an indicator of the future, so just something to bear in mind while we do like to add it as one level of our investment thesis, that essentially they could perform a lot better, but they could also perform a lot worse over the next 10. Second piece is just to compare against the S&P. Now, you probably already know the answer, but let's have a very brief look. Amazon, marginal outperformance over the last year. Over the last 5, marginal outperformance. Over the last 10, massive outperformance. Question is, can they continue that significant outperformance? Otherwise, perhaps consider a low-cost ETF that tracks the S&P like VO as part of the portfolio. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $222, we have the free cash flow year on year, the average growth rate, which is negative 3%, but bear in mind this is skewed due to a few years being negative. Now, we've gone for 20%, although we do have a low, medium and high rate. Based on the 20, with the discount rate, we have the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, intrinsic value $222, indicating 13% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any others that you do desire. But we do believe, in fact, we have gone very conservative even from the next full year, given that we saw earlier on it is anticipated to pretty much double. Now, for full transparency, we will show you at the 25% rate, we get $314, indicating 60% upside, and for those that believe 30%, well, $439, that is 123% upside, in fact more than double the current trading price. Now we'll take through the 20% rate into the next slide, where we will apply our margin of safety, and as always on this channel, we'll start with 10%, execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward looking data. Now if you believe that, for Amazon today it is a buy up to $200. Then we keep going till it's near the current trading price, and it's not at the 15% level, which would be around the $189, $190 price. So today's episode, we see this around 10 to 15%. Wall Street, on the other hand, as we saw, a strong buy rating, $240. They believe upside of 22% over the next year, and definitely one for serious consideration in the portfolio. Now, we have covered other Mag 7 stocks which do look undervalued, like Alphabet, but Amazon does look to have a very good prospect moving forwards. There are some other things that we didn't cover in today's episode that we have in previous episodes, where they are looking at using further robotics in their warehouses to really reduce the cost and improve the margins that we have seen over the last few years. And we do believe with a lot of capex investment they are doing in this area, we'll see growth not just in the top line, but also in the margins, the bottom line, which in turn will be a massive benefit to the shareholder. As always, give us your thoughts in the comments below. Is this one you're looking to buy, maybe one you're holding, or in fact a reason that you are looking to sell? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below. We're dropping a new copy Monday morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.